Alright, today is Friday, August 28th, and this is a post-market review for today's activities in the stock market. We will cover the usual, the closing of the market, sectors performance, futures performance, options performance, the headlines of the day, the heat map analysis, an update on the rotation trade, and of course, the charts analysis. And then we will conclude on what to look for next week. We have an important week coming due to the stock splits. The stock splits will take effect next week. And there is, of course, the shuffling of the Dow Industrial Average. And next week will also mark the last day of the trading in August, and we will shift into September and the heat of the elections season here in the United States. And here we go, the Dow Industrial Average closing in the green by 161.60 points or 0.57%. The Nasdaq closing in the green 70.30 points or 0.60%. The S&P 500 closing in the green 23.46 points or 0.67%. Shifting to the sector's performance, here we go. The gold medal goes to materials, led by gold, of course, ironically, and the silver goes to energy, and the bronze goes to technology. There are no losers today. Everything closing in the green. The breadth of the market is a lot better. And moving on to the futures. Leading the day, Lombard, of course. However, you see the red box. That is wrong. I don't know why they keep getting it wrong. Perhaps Lombard went too high and too far. It is causing a glitch in their system. But Lombard closing in the green by more than 3 percentage points today. Coffee closing in the green, big. We missed that one. OJ rebounding from the losses for the last 2 days, and Coca no stop and sign here. We also saw soybeans and soy-related products catching a bit today. As to the laggards, you can see rough rice giving up the gains from the last few days, and lean hogs dropping in the red again. We closed that position a while ago. That was a good decision. And of course, oats closing in the red today. I have a position in oats, and it's not reacting as I expect so far. We'll give it a little time. And here is sugar giving up some of the gains for the last few days. And of course, I'm eyeing opening a position in sugar. Now, shifting to the big casino, the options market, it is muted with exception of the stock splits of Apple and Tesla. You can see Apple was busy today, 1.2 million options traded, 67% of those were calls. And of course, we saw the funny business that happened at the end of the day where Apple shares rallied and then they dropped like a rock. And a lot of traders are confused what happened there. There are a lot of theories. One of them is, of course, the stock split confusion. A lot of people don't know whether they should hold the stock through the split or not, or buy it before the split or not. And you're going to see more of that confusion next week. It's going to be epic and very comical. But my theory here is, of course, we are a gambling-driven market. We're driven by the action in the options market. The stock market doesn't matter anymore. It's all about the options market and the gamblers on Robinhood who are betting on calls every day. What happens is option riders will sell, say, the 490, 495, and they sold the 500 strike price for Apple calls expiring this week. The vast majority of the volume the last few days of Apple calls were the 500 strike price. Now, as we got closer to the end of the day, the closing of the market, and the stock was hovering around just under 500, 499, 498, a lot of those who wrote the 500 strike call are now becoming nervous, and what they do is they buy the stock because they did not hedge when they wrote the option. So now they buy the stock, and that causes a big pump and a scramble, a panic at the end for all those riders to buy the stock, and you saw Apple shares pushing higher. However, they weren't just going to hand you the shares for $500 and lose money. What they did is they dumped all together, causing that big sell-off, and they managed to close Apple shares just under $500, making all the options the gamblers bought for the 500 strike price expire worthless. This kind of volatility happens once in a while, and of course it is market manipulation via options activity. But this has been going on for the entirety of the summer here. Everything is being manipulated through the action via the options market. We also saw Tesla experiencing very huge increase in volatility, and some people woke up saying, hey, I have puts or have calls in Tesla, and Tesla's trading in the red, yet the calls appreciated. That is, of course, an effect due to the increase of implied volatility. Volatility will continue to pick up. Next week, we have the split. It will be already done and gone, and traders are expecting a lot of volatility to happen, upside or the downside. Nobody knows what's going to happen, but that does increase option prices. And of course, at number 3, we saw NEO was down big today, yet the calls options were 64% calls, and you see the theme of the gambling mania continuing in the options market. And now, moving on to some important headlines that shaped the day. We're, of course, tracking the whole Fed decision fiasco from yesterday and the implications of that decision in the economy. And today we had some more clarity due to certain Fed presidents speaking. And here is an interview from CNBC with the St. Louis Fed President Bullard. And this interview is very disgusting. I just have to warn you beforehand because this guy is so smug and out of touch. It's unbelievable. And of course, don't expect CNBC anchors to challenge him whatsoever. So let's take a listen.
Let me get your sense of how that might work in practice. When we talk about letting inflation run above 2% or averaging out to 2% over time, what's your tolerance for inflation to run? Is it 2.5%, 3%?
Okay, so they're talking about inflation target as some cake recipe that you can adjust however you want. We know from history that the Fed has the power to spark and elicit an inflation reaction in the economy to reduce or increase, but they don't have full control over inflation. There are other factors that controls inflation beside the Fed. And we know that the low interest policy been going on for years and years, yet the Fed failed to meet their inflation target. So what makes them think that playing with interest rates in the future will control inflation one way or the other?
Yeah, inflation has run below target, certainly by 0.5% for quite a while. So it seems like you could run above for 0.5% for quite a while. The idea here is to cement inflation expectations at the 2% target because you really want that credibility all the time. That's a key aspect of central banking. And I think that this lower bound or the zero lower bound is kind of dragging average inflation down over time. That's certainly happened in Japan. It's happened in Europe. We don't want that to happen here. So we want to be sure that we can cement inflation expectations at 2% by actually hitting 2% on average over time.
I want to return to the current state of the economy, President Bullard. Let's talk about what you're seeing right now. We've had the resurgence of the virus. Are you seeing a knock-on effect in terms of the recovery of the economy?
I think we're continuing to expand here. This will be one of the best quarters ever for economic growth in the U.S. Makes perfect sense. You're coming off the very negative second quarter. I think you're getting the disease under better and better control every day. Businesses are learning how to adapt and how to get their revenue streams back up to where they were. Some businesses actually doing better. Obviously, some are hit very hard, but you'd expect that kind of uneven reaction to the crisis across the industrial sectors. So I think we'll grow really rapidly here in the third quarter. 20+%. Some tracking forecasts are 25% at an annual rate or higher, and then I think you'll continue to grow in the fourth quarter and first quarter. So I think we're in the recovery phase here. I think the recession was only 2 months, even though it was very sharp.
So this moron is expecting this quarter to be one of the best quarters ever. He's absolutely out of touch, just like the rest of the Fed, thinking that if they can inflate the stock market somehow, that would trickle down in the real economy and we're going to have the best quarter ever. Please remember this and hold this guy responsible if the economy deteriorates and if we see that this quarter's GDP and the economy is actually trending lower and it's not recovering as fast as we expect.
President Bullard, it's Sarah Eisen. Good to have you back on the show.
Hi, Sarah.
At what point do you need to slow down QE, including the purchases of corporate bonds? How are you thinking about that?
Yeah, I think I'm with the chair here. We're not even thinking about raising rates, and I think we've got a good policy in place right now. I just continue this policy. I don't really think this is about monetary policy. This is about the virus and the economy adapting to the virus, the risk management around the virus, and the contagion that would otherwise occur. I think our monetary policy is just right for this situation. We're have a low policy rate. We're going to stay low for a long time. Markets expect us to stay low for a long time. We're encouraging market functioning through the purchases, but also through the 13.3 programs that we have. Our liquidity measures are looking very good. We're staying out of financial crisis. You don't want to be in a financial crisis on top of the pandemic, and so far we've avoided that. So all of that is looking very good. So I think it's steady as she goes for the Fed here.
Quite the opposite. Record highs every day here. What about the permanent damage? We just reported on some of the layoff announcements, even from strong companies that are doing well, like a Salesforce or Nike or Coca-Cola, taking this opportunity to reset their businesses and announce more structural layoffs. How are you thinking about how much damage is going to be done permanently that will not come back when we have a vaccine and when the economy snaps back?
Yeah, well, I'm worried about it like everyone else, but I also think that, you have a big disruption like this, you should expect businesses to be reexamining their models, they're positioning themselves for the future. And, I'm not surprised that you get a big rethink in some of these industries. Even successful companies want to rethink where they are and how they're going to position themselves going forward. I wouldn't say, all of that is bad news necessarily. Obviously, if you're the person that's laid off, that's bad news. But if you're thinking about how can you keep the firm competitive going forward, that part could be good.
Really? Firing people could be good? Wait a minute. We thought that the entire purpose of this tsunami of liquidity is to preserve employment. That is your main mandate. So now you're telling us that that's okay. We provided the liquidity, and the liquidity will go into inflating stock prices via bond and stock buybacks and executive bonuses. But this liquidity is not going to go into preserving employment. What is the point here? Why did the Fed usher the tsunami of liquidity if it's not going to help preserving employment? He even goes further, saying that it is a good thing for corporations. They never cared about employment. That is not their job. Their job is to protect and inflate the assets of the wealthy.
It's John Fort, and I'm thinking a lot about small business these days. We've long talked about small business as the engine of the economy, and as I look at the markets, as I look at this recovery, it sure seems like large businesses, especially the larger public companies, are performing better. Are you satisfied with the way small business has been participating or left out of the recovery thus far?
Yeah, I think this is very hard on small businesses, although many of them are very innovative. I think bigger companies, if they have hard driving sorts of managements, they can adopt simple measures. I think that's what's so impressive about the second quarter. You look at somebody like a Walmart, able to adopt really simple personal protective equipment, mask wearing, other kinds of safety features, and then run their business and have a great quarter. If you're a very small business, you may not be able to adapt fast enough. Your customers may just be afraid of coming into your store. So I think that they've really borne the brunt here. But they also have fiscal package through PPP and other programs that are trying to reach out and help them. And so hopefully they can copy the things that the essential industries did during the second quarter and adopt those approaches to their business and make sure they get their revenue stream at least up to the point where they can get past this crisis.
And again, listen to him. He's talking about small businesses. Oh, it doesn't matter. Yeah, some of them are going to struggle. That is sad, but who cares? As long as Walmart is doing all right.
Jim, just a final question here. If I know you, you're sitting there thinking like, where's the bubble question? Well, look out, because here it comes. You said you're going to be easier on inflation or more tolerant of higher inflation. You're not thinking about, and in fact, the chairman is not thinking about raising interest rates. Why is that not a massive green light for people to go out and not just buy good stocks, but buy any stocks, and you create asset bubbles through this Fed policy that create danger and systemic risk to the economy?
Well, one of the things we did in the framework review, if you read through the new document, it has more reference to financial stability. And I think all members, to some degree, are concerned about this issue and want to be vigilant on this issue, some more than others. But I think I was pretty happy with the way this came out, that we were able to get a little bit stronger statement on the idea that we do worry about asset price bubbles. We are aware that the 2001 recession and the 2007 to 2009 global financial crisis were a bursting of asset bubbles, and we do want to guard against that going forward. But I would also say that, you look at somewhere like Japan, which has had low interest rates for a long time. They really haven't had this same issue of creating a bubble. So this is just something we're going to have to watch very carefully going forward.
Sounds like the weather, Jim. Everybody complains about it, but nobody ever does anything about it. Anyway, thanks for your time, Jim. Appreciate you. All right,
thanks a lot.
Ha ha ha. Of course, look at Steve Leisman making jokes and funnies with Bullard about the weather. And they're laughing that there's nothing going on here. There's no problem. Ask him about the bubble and he just laughs about it and just to have a good laugh. And I tweeted this tweet saying that you could have asked him one question. How does inflating a stock market bubble helps the poor and the middle class? Aren't you guys claiming that the Fed's purpose and objective isn't just financial market stability, but also preserving employment and helping the overall economy? Explain to me, how does inflating a stock market bubble helps Main Street? They didn't ask that, and don't expect them at CNBC to ask these questions ever. And of course, here's another interview with another Fed president from the Cleveland Fed this time, Mr. And she's another out-of-touch Fed zombie, even though you can give the anchors this time credit for asking better questions and being a little more aggressive.
I'm curious what you think about the inflation, if you could call it that, that's happened in the stock market. And whether you, in the public stock market, that is, during this period, if you had told me that we'd have 10% unemployment and the market would be where it is today, I probably would not have believed you just 5 months ago. And I think there's a real concern about that. But if you talk to people like Ray Dalio or Mark Benioff and others, they're talking about inflation in other places like the markets, like housing and the like, and the inequality that may come with that.
So, I mean, asset prices are something that we look at in terms of financial conditions. We don't think about that in terms of inflation per se. When we're thinking about inflation, we're thinking of goods and service price inflation when we're looking at our goal of 2%.
So here we go. All right, let's stop here. She's saying that we don't take in calculation financial assets inflation as a component of our measure of inflation. That does not make sense. The whole point of tracking inflation is to protect the economy from bubbles and bursts. And we know from past experience, at least in the 2009 case, there was a financial market bubble that caused the crash in the economy. So why keep the inflation in financial assets out of the formula when you calculate inflation in the economy? It does not make sense. But again, this is not their objective. They could care less if they create bubbles and bursts and retail traders get hurt at the end. The billionaires, of course, they will hit the sell button. The insiders are already selling, booking their profits, and this is the Fed's objective. We don't care about bubbles and inflation in the stock market. That is actually our secret mandate.
But, I mean, one of the things that the new statement does say is that when we're doing, trying to set monetary policy to look at, to hit our two goals of price stability and maximum employment, we do take into account financial stability, because, financial conditions are stable, financial markets are stable, we can then hit our goals, and vice versa. There's a linkage there. And so risk, we routinely look at risk in the financial markets. Yeah, and stock prices are high, and it does look like they're being driven by where investors think the economy is going.
Continuing. All right, here's a fallacy. She's saying, oh, investors are betting where they think the economy is going. That is absolute bullshit. We all know that the economy is in shambles, and we live here in planet Earth, not Uranus. So we know the environment and we know the pain here, where small businesses closing, people losing their jobs. But market participants, and specifically the Robinhood gamblers and the likes, are betting on the stock market as if they were betting on horses, because they know that the Fed is behind them, inflating the bubble and whipping the horse to run faster. And we all know from history how that ends. It gets out of hand. The bubble becomes too big and the Fed loses control and the bubble bursts. And who gets hurt from this scenario? It is retail traders, it is mom and pops, it is retirees in their 401k accounts. Those are the people who get hurt. The billionaires and corporate insiders, as you know, been dumping stocks and cashing in. And what they do after the crash, of course, they wait for the crash. The bubble is good for them, but even better is the crash, because they can use the cash they acquired from selling the shares to buy them now back even cheaper, and the rich becomes richer. This is how the cycle happens. The Fed does not care about that. And moving on to other headlines, let's check out on the market mania. What's going on with the market mania? Here is a headline for Business Insider saying that markets are marching higher due to quote-unquote investors being confident that the data is signaling continued recovery in the economy. This is again the bullshit narrative, assuming that investors are pushing the market higher because they're optimistic in the economy. Nobody's doing that. We're doing that because we know this is a bubble and the Fed is going to continue to inflate it, and the market has become a big casino with all these amateur traders betting every day as if they were betting on horses. And speaking of the continued recovery, of course, Coca-Cola is now firing thousands of employees, cutting thousands of jobs due to the restructuring plan. And more news about the continued recovery. Here is MGM Resorts laying off over 18,000 employees. And moreover, here we go. Banks, of course, pledged not to fire employees when the crisis first begun. But now the economic conditions and the financials are getting really bad. They will have to cut costs and fire employees. This week has been really horrible for the employment picture. You've heard about the 19,000 jobs lost in American Airlines alone. Add to that another 5,000 jobs lost in between Delta and United Airlines. Now we have Coca-Cola, MGM, and banks, and more retail businesses. We heard, of course, from Bed Bath & Beyond firing over 2,000 employees. This is the bullshit narrative of the V-shaped recovery, continued recovery, and the Fed telling you that, oh, the stock market is just going up, not because it's a bubble or because of us. It's going up because investors are assuming and betting that the economy is going to recover. Bullshit. Here is the real data. And speaking of real data, here we go. Consumer sentiment. Remember when Kudlow came on television a few days ago and said that there's a consumer and consumption boom in the economy? Well, the Minister of Propaganda, of course, missed out on this information. Consumer sentiment increased slightly this month compared to last month, but it is still well below pre-pandemic levels, and it is trending lower when you compare it to the number from the month of June. All right, moving on to the heat map analysis. Here we go. The breadth is a little better today. You saw participation from lagging sectors such as energy and materials, yet healthcare lagged just by a little bit, and you saw technology a little muted, with exception, of course, of the bubble in the semiconductor sector, such as Nvidia. You see Nvidia up big today. How high are you going to take the stock? Of course, it's a good company. It's growing 50% year over year. But now the stock price is assuming that the company is going to grow 100% year over year. That's just not realistic at all. Given the circumstances, this stock will correct, and it will correct hard. But for now, the bubble in the semiconductor industry and sector continues. We have other bubbles, of course, in the credit card processing companies such as Visa and MasterCard. We know that these companies are benefiting from the pandemic environment and the stay-at-home and shop-from-home environment. But investors took these names way above the financial benefits these companies have reaped from the conditions we're living in. They're now pricing euphoria in these stocks. And again, that goes with the same narrative we heard from the Fed. Investors are not buying Visa and MasterCard, pushing them to all these valuations because they think the economy is going to get better. They're doing it because they're amateur investors stampeding on certain names with no regard to their valuations because they think that the Fed has their back and the Fed will continue to inflate the bubble. And you can see that narrative, of course, with Walmart stock now at the top right corner of the screen. You see Walmart, the big green box, closing in the green 2 days in a row. Up big this week due to the stampede of the TikTok mania. The rationale is gone from investing, and now it is just pumps and dumps and manias of pushing stock prices to infinity. And moving on to the rotation trade, the vaccine rotation trade. Let's see what's going on here. Here is the daily scorecard, and as you can see, that the comeback stocks have outperformed today, closing big in the green. Technology, or the garbage stocks, the formerly known as momentum, didn't do bad either. Some names lagged like Apple today and Tesla, but they're still holding on, and we're not seeing a mass confirmation of the rotation, meaning that certain actors in the market, perhaps professional funds and some value hunters, are shifting to those comeback stocks. But the main narrative, it's still with tech names, the usuals: Facebook, Microsoft, Apple, Tesla, Amazon. That trade is still intact, and it's still appealing specifically to the newcomers in the market who entered in March and they think these stocks can go up and up forever. And you can see that when we switch to the weekly scorecards. This is the performance of the rotation trade for the week. You can see that the comeback stocks have outperformed. They're up big, but the names on your left hand side, specifically the tech names, they still performed good and they closed in the green, and they have big gains for the week as well. Now, if you've been following me for a while, you know that I'm shifting toward the comeback stocks and I'm adding to them, so I'm happy this week. I have nothing to complain about. However, these moves of 18%, 11%, this is not sustainable, and you will see hard reversals from these gains. I would like to see smaller, sustainable gains in the rotation. I haven't seen that yet. All of what this does, it makes the overall correction scenario in the market more possible, because if we do have a correction due to volatility of the election or whatever it is, if we do have the comeback stocks up 20, 30, 40% for the month, you bet that they're going to get hit too, along with the high flying names on your left hand side. They're all going to experience the hit of the correction, and this is something that I don't want to see. And this is why I've been saying, if you are participating in the rotation trade, nibble in smaller positions gradually, because you don't want to go all in and you see your stock up 22% the last few weeks, and then you have a harsh correction that erases all your gains. That is not fun. So we want to see healthier, sustainable gains in the rotation, and we haven't seen that yet. But we will keep tracking the rotation every day, every week. And of course, we will keep our eyes open if there is an overall correction in the market. And now moving on to the charts analysis, beginning of course with the weekly chart of the SPY, the S&P 500. This is the closing of the week, so we're looking at weekly charts. And right away, you see that the SPY is making this 90 degrees move, which is absolutely unhealthy. And it's not the way the stock market behaves. You only see these kind of moves in manias and prior to very steep corrections. Case in point, let's look at where we've seen this look before. And you can see as I circled and I pointed out on the chart right in front of you, we've seen that back in 2018 in February when everybody stampeded on buying stocks due to the tax cuts. And what happened, of course, is we saw a very harsh correction and very historic correction after that. So again, I'm keeping my eyes open and I'm watching and anticipating a very harsh correction here. A lot of traders, they look at the chart and they're seduced by the big move. For me, a move like this makes me more worried. And when we switch to the triple Qs, the NASDAQ, you can see the same thing from the weekly chart. We're making the 90 degrees moves right now. Vertical, impulsive moves to the upside. And we are now far, far extended from the 2 weeks moving average. Not healthy at all, and a recipe for disaster to come. And don't say I'm just being doom and gloom and negative. Look back at the chart, scroll all you want. From a weekly perspective, you can go as far as you want and measure the divergence between the 20 weeks moving average and the historical chart of the Qs. This divergence is among, if not the biggest we've ever experienced in the NASDAQ, and every divergence was corrected. The higher the divergence, the steeper the correction. And now moving on to the VIX chart from a weekly perspective. If you've been following the VIX futures, you know that we've seen a spike in the VIX futures, meaning predicting more volatility in September and October prior to the US elections between Trump and Biden. This election season is going to be very nasty and very volatile, and this is what the market is predicting ahead of time. And you saw the VIX closing again in the green for this week in addition to the week prior, and it's curling up from a MACD perspective, ready to cross. All the signs and signals are in favor of a big pop in the VIX, which will not translate good for the stock market overall. So my advice, if you have long positions in the market, consider buying the VIX to protect against any volatility that could hurt your gains from those long positions. Furthermore, if you are a bear and you want to bid against the market, consider buying the VIX. However, be careful of buying a highly volatile proxy of the VIX like the UVXY. A lot of guys like to gamble and they buy options on the UVXY, and that is not a good recipe, because if the VIX doesn't move right in the time frame that you expect, those options will expire worthless. So the way you do it is you give yourself a little time. We know that September and October are going to be very volatile, so maybe you want to buy the October volatility option and then sell the September one and turn it into a calendar call. And better yet, you can do what I'm doing. I'm buying the VIX directly. I'm not buying options because I can't time when the VIX is going to pop. But I know it's going to pop. So I hold the VIX as a position and I sell covered calls and I add to that position gradually and periodically. Let's look at gold. What is gold doing for the weekly chart? Here we go. Holding support. You see gold holding support, not breaking support, and allowing the 20 weeks moving average to catch up with the movement. This is a very, very healthy behavior, and I opened a position in gold, but I will wait a little more to go in heavy. And if you watched yesterday's video, you know what I'm waiting for to add to my gold position. Now, switching to the dollar index, here is a weekly chart of the dollar index, and you can see this is a bearish look. If the Fed is going to increase inflation, if yields for the treasuries are going to rally, all of this create conditions unfavorable to the US dollar. So we're still bearish in the US dollar, and here is my target. I think the US dollar will collapse all the way to the 2018 levels. And now, let's conclude the video by looking at the charts of Apple and Tesla. Of course, Apple and Tesla are splitting on Monday. They were already split, but the split will take effect on Monday. You will wake up, you'll look at your screen, your brokerage account, and you'll see the prices different than what they were on Friday. So expect a lot of confusion, a lot of stupidity, because some traders are going to wake up and they will think that they've lost money, that Tesla crashed or Apple crashed. Some of them, of course, will figure out that the whole stock split mania was not justified because they did not get 5 free stocks and everything remains the same. Now, in theory, the stock splits are supposed to make it more accessible for retail traders who cannot afford the stocks at these prices. We will see what happened on Monday. If we see a surge of new buyers from Robinhood and all the other Webull and whatever other garbage they use, if we see a stampede to buy the stock, then the theory is justified, at least in the short term, that the stock split is effective in attracting new investors. However, there's a flip side to that coin, that the split move already happened before the split. Investors and traders stampeded to buy these two names and pushed them really, really high impulsively before the split even happened. So you're putting yourself right now in the risk of the sell the news phenomena. Meaning, if we don't see the surge of new traders stampeding on Apple and Tesla shares, the psychological reaction of some of the holders of these names will go as the following. Wait a minute, we had the stock split and nothing happened. All positions are the same, but we did not see the stampede from new investors. So perhaps this is a good time to press the sell button and lock in the gains that I have while the stock is still high. If that happened, that creates the domino effect, meaning somebody presses the trigger, sells the stock starts trending lower in the red. Other investors, specifically new ones who bought Apple and Tesla at very high valuations, start to panic when they see their gains are being reduced or even their gains completely gone, and now they're dipping into the losses territory. They will panic, they'll press the button, they will sell, others will follow. You see the domino snowballing effect of very impulsive movement and correction to the downside. However, there's another thing that you need to keep in mind, and it is psychological. The long-term holders of Tesla and Apple waiting for September. There are events in September that are really important for the stocks, and they think that these events will validate the movements, the impulsive movements in these two names. The first for Apple, of course, is revealing the new iPhone 12. And you will see, even if we see a sell-off on Monday or next week in Apple and Tesla, you will see other traders buying the dip and recovering the name due to the expectations of the upcoming events. In Apple, that is the iPhone 12 reveal, and in Tesla, it is Battery Day in September 22nd. Battery Day, this is the revelation that the cult, the Tesla Elon cult, are waiting for. Apparently, during Battery Day, Jesus will descend down from heaven and he's going to recommend that everybody buys Tesla stock. So if you are a bearish trader on those two names, Apple and Tesla, be careful not to jump the gun too quickly and be seduced by the low put options premium, which will become more accessible, of course, after the split. And you buy these options or you short the stocks right away, and then you get surprised that yes, the stock may be sold off a little bit initially, but it was rescued by buyers anticipating the events in September, the iPhone 12 reveal, and the revelation of Battery Day. So what I would recommend here is follow the psychology. Wait on Monday. If we don't see a surge in buying in these two names, then you can play short term by buying put options for the short term, expecting a sell-off, a decline temporarily. You make your gains, you close your trades, and that is it. And then what you do is, when they recover the stock, when the cult comes in, buys the dip, you buy call options, and you'll make money from the recovery after the dip. However, you preserve your main shorting position until after these events are revealed already and we're past them. Make no mistake, if we do have an overall correction due to a black swan or something related to the election, everything will get hammered equally. Tesla will go down, Apple will go down, everything will go down. But I am talking about if current market conditions continue, absent of a black swan, absent of an overall correction and crash in the stock market. This is how these two names will behave. Initial sell-off, a recovery, and then after the revelation, these two stocks will stand naked. There are no tailwinds anymore, and the financials will take center stage, meaning we'll now have to ask the questions. Will earnings justify the valuation? We know in Tesla it doesn't, but Tesla always had a tailwind event that everybody's waiting for. Battery Day, Gigafactory, whatever the hell it is. Now they have nothing. After Battery Day, they got nothing. They have to sit down and justify how the hell is the company at this price justifies negative earnings growth. And the same argument goes for Apple. So preserve your big shorting move until these events are past, because these two stocks will have an epic crash thereafter. And looking at the charts, you can see from Apple's chart, there's a big reversal candle from a weekly perspective, and you see that the put to call ratio is starting to recover, so you're seeing more bearish bets, and you see, of course, the price to sales ratio at all times high. All recipe for big, massive corrections. And when you switch to Tesla chart from a weekly perspective, it is the same thing. You see the indecision weekly candle, and then you see the put volume increasing in the name. And of course, the price to sales ratio is in the stratosphere, meaning that the correction will be extreme in this name. The Tesla cult avoided the correction for about a year now, but they will have to face a bigger, massive correction because they've pushed the valuation beyond any reasonable explanations. Specifically, when you look at a company from its last quarter report that did not report an increase in profits, they barely made any profits, and they made it, of course, due to the government environmental credit. Now, when you combine all of this information with the fact that we have a VIX that is curling up, we have VIX futures that are predicting more volatility, and you combine this, of course, with the upcoming election season, which is going to be very volatile and very nasty, with a lot of surprises. Both sides are armed to the teeth. They have nukes on their sides, and they will release those bombshell information to each other. You're going to see a very nasty battle in this election season. Will create a lot of volatility and a lot of uncertainty in the market. The market does not like the word uncertainty. When we get to the point where we're not sure if Trump or Biden is going to win, at the end of the day, it doesn't matter. Whoever wins, the policies are going to stay the same. The Fed will continue to flood the market with liquidity. You're going to see ease in regulations either way because, of course, they have to make exceptions due, of course, to the hardships of the pandemic. We know that from a corporate perspective, there are no hardships. The pandemic is the best thing that happened to them, but both parties will do whatever they need to do to prop up the economy and the stock market. But needless to say, the uncertainty and the panic could be very extreme, specifically given where the stock market is and the fact that we are in a bubble. It could be a massive crash before the election takes place. Out with the summer mania and the summer joy, and here comes the red storm of September and October. If you have any experience in the stock market, you know September and October historically have not been very generous to the stock market. So buckle up. The ride is about to get even more interesting than it already is. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.